Excellent. I guess I called mine tax strategies for real estate professionals, but
Oh, okay, perfect.
a little. Well, we're going to run through in our agenda today the basics of financial statements, what type of business real estate brokers should be, stories from the trenches with a specific real estate story on tax savings with the different types of business entities and the help that we've done, and then tips and tricks to look out for. I'm also going to do a little bit of bonus content about the new rules around 1099 contractors, but I'll go through that pretty quickly. So the reason I'm able to do this is because I'm the founder of Zccounting, and we work with over 300 entrepreneurs across the country, probably closer to 400 today since we're growing pretty fast. Dozens and dozens of real estate agents. We've got a partnership with John L. Scott to help deliver the S-Corp products and stuff like that. Also, Larry on our team, he's our in-house CPA. He runs our whole tax group. 10 years of experience, and he's really great. And he's got a passion for real estate and entrepreneurs and all that stuff. So let's dive straight into it. And I'm going to also open the chat. So I hope everyone else has their chat open, because what I like to do is I like to make this slightly interactive. So the basics of financial statements start out with sort of your profit and loss or income statement. And so when you're thinking about your profit and loss and income statement, you've got revenue less expenses, which equals your net income. So does anyone have an idea what, well, I'll just throw it out there. Revenue is typically your real estate commissions, your percentage that you're getting for revenue, and any other sort of fees that you might get off the HUD or otherwise monies that you make elsewhere. What are types of expenses that would be deductible to a real estate agent, realtor, or broker? Anyone want to throw some stuff up there?
Miles.
Marketing, perfect. Yeah, marketing would definitely be one of those expenses. What else? What else?
Gasoline.
Gasoline, yep, gasoline for your vehicle. Absolutely. Yeah, a lot of windshield time in real estate, right? A car, if your car is leased, it will be an expense. If your car is owned, it will be an asset. Desk fees, yep, absolutely.
Membership. You typing in desk fee? I did.
Membership, perfect.
Home office.
Home office, yeah, home office is a deductible expense. I'm going to throw out there right before I show you all the answers or some of the answers that I've proposed. The net income is the amount that you end up paying taxes on. So revenue less your expenses equals your net income. So here are the various things: marketing, business meals, cell phone, rent, deductions, desk fees is sort of a rent, sort of analogous things. So when you're looking at the income statement, the more deductions you have, the less you'll pay in taxes. So revenue less deductions equals net income, so less in taxes. However, watch out, because the more deductions you have, the less income you have, which means the less borrowing ability. And so I know a lot of real estate professionals like to invest in real estate as well. And so just be conscious that the more deductions you have, the harder it's going to be to show enough income to maybe buy that dream property. Diving into the next financial statement, the balance sheet. Balance sheet is all of your assets of your business, less your liabilities of the business, which ultimately gets to your net worth or the equity that you have in your business. And we're talking about the business, we're talking about the real estate agent themselves as their own business. And so when thinking about assets, the most obvious asset is the cash that you have in your business bank account. What are other assets? I know someone said car before, and I explained that a leased car is an expense, and this is where the purchased car would be an asset. What other assets might a real estate broker have?
Their home.
So on a personal side, I don't think that the business would own your home. On a personal side, that would be a personal asset. I'll just throw out a couple more things here. Um, Staging assets, your office equipment, your laptop, your cell phone. If you were to buy a rental property, that real estate would be an asset. So, and then in terms of liabilities, I'm just going to jump to it. Credit cards, loans, unpaid bills, prepaid revenue. In some cases, maybe you'll get an advance on your commission. That would be a liability. And so you can count future business as an asset. Jen, I would probably say future business is not a tangible asset. Um, So no, the quick answer is no. I'm trying to think of the exemption because a lot of cases accounting is both an art and a science. So there may be some way. I think Enron counted future business as an asset. They did mark to market, but everyone at Enron went to jail. So we probably won't be counting your future business as an asset. So anyways, diving and comparing both financial statements, we got the income statement on the left, we've got the balance sheet on the right. So if you have assets, depreciable assets, they're added back in as a depreciation loss. However, your income used for borrowing is the top income. Your taxable income is after depreciation. So with depreciation, you'll save money on taxes, but you'll still have the high borrowing ability because depreciation gets added back when you're borrowing. However, the more loans and credit card debt and other business loans and expenses, that type of I guess loans and credit cards, that has an interest expense on it. Loan payments come out of your net income, so it has less money take home because you're paying off the loans, and the interest becomes an expense, which lowers your borrowing abilities. So the punchline here is invest in assets, watch out for debt. So now we're going to dive in to the three most common business types. There's also ones like trust and other weird stuff, but we're going to talk about the ones that are going to be most common for a real estate agent. The great thing about being an American is everyone has a business license. It's called your social security number, and you can just be a sole proprietor on your social security number. I'm not a lawyer, but if I was a lawyer, I would tell you your social security number doesn't provide you any liability protection to protect your assets, your home, your cars, or anything if there was any problem or if there was any accident and you were to get sued. So I would highly suggest that if you just want to be a sole proprietor, a single member LLC would be a really great way, or an LLC partnership if you're working in a group. I'm going to skip over S-Corp and I'm going to talk about the C-Corp. C-Corp is your corporation like a Starbucks or a Microsoft. Those are all C-Corps, but you can have a C-Corp as an individual and be a sole shareholder of a C-Corp. C-Corp files its own tax return, does not relate to your personal tax return. And I'm sure you've heard that there's double taxation in a C-Corp. After the C-Corp pays a flat tax of 21%, then any distributions to the owners are then taxed at 0, 15, or 20% in a dividend tax rate. And so C-Corp does have first the corporate tax, then the dividend tax. However, if you paid yourself a salary from the C-Corp, that salary is deductible and the salary is not double taxed. The S-Corp allows you to do the best of both worlds from your single member LLC that's filed on your personal tax return or the C-Corp which files its own tax return. The S-Corp says to a C-Corp, we want to pass through all the profits without tax. So let us file our own tax return, the same tax return as the C-Corp, but we add a S for the S corporation part of it, so that all the profits are allowed to be passed through to the individual on a K1. Or you could say, I want to turn my LLC into an S Corp, where I get to treat it more like a corporation, pay myself a salary, take additional sort of deductions around investments and 401ks and stuff like that. So the S Corp is really the hybrid between the LLC and the C Corp. And again, sort of the general consensus is that the single member LLC or the LLC partnership is the easiest and most simple to create and to operate. Challenge here, the real caveat is you're subject to a self-employment tax for all profits of this LLC, which is 15.3%. So for every 100,000, you're paying over 15,000 right off the top in self-employment tax before paying your regular tax rate. And of course, the C Corp is the lowest tax rate for business. It's a flat tax at 21%. So if you're looking at a 15% plus your regular tax rate, it sounds a lot better to be in the C Corp. But to get that money out of the C Corp, you got to pay an additional tax, either payroll taxes or your double taxation. If you have a corporation and you don't need the money, the C Corp will be the most efficient to reinvest in your business, which is why a company that's growing fast like Starbucks, Microsoft, or Meta would use a C Corp. So again, the punchline here is going to be the S Corp allows you the best of both worlds, transferring the net profits after you pay yourself a salary with no self-employment tax 15% penalty. I guess it's not technically a penalty, it's your contribution to, the overall tax bucket. And Uncle Sam, And it also allows you to separate that business from your personal tax return, so that in the case of an audit, if you are audited personally, your business isn't affected, or if your business is audited, your personal isn't affected. So I'm going to show you what it looks like in a single member LLC or a sole proprietorship. And I'm just going to throw it out there. If you have a partnership, your portion of the partnership income would look like this. And so the LLC tax return is filed on your Schedule C of your 1040. You can only take owner draws. You can't pay yourself a salary. So when borrowing, you won't be able to show a W-2 income. You're then hit with the 15% self-employment tax. Then you're hit with income tax. So say on $1 million of income, because $1 million is a nice round number. And if you sell 3 houses in the Seattle area, you're probably making $1 million anyway. So you have $1 million of income, $150,000 of self-employment tax, $370,000 of federal income tax. So your take home is $480,000. So the comparison to the S corporation with all the same information, the S corp files on a separate tax return. The K1 delivers all your profits to your 1040. No self-employment tax if and because you're paying yourself a fair wage through W-2 payroll. And your payroll becomes a deduction of the business. So every time you pay yourself and you pay taxes for yourself, you get to deduct that as a portion of the business. So on $1 million of income, let's say you paid yourself half of that, so 500,000 of W-2 wages. There's a little bit of tax that's on those W-2 wages that is a deduction. So your net income becomes 465 out of the corporation. Your tax that you paid was that 35,000 difference. So your distributions are 465 with no self-employment tax, but you already paid wages. You already got a net payment of 185,000 and having some other taxes withheld, or sorry, 357,000 with 185 of taxes previously withheld, with your net take home when combining your W-2 and your K1 of 573, almost 100,000 more by just changing your legal entity type and avoiding that self-employment tax. I'm going to jump to the C Corp because the C Corp is really easy. It's filed on its own 1120. You can be an employee. Dividends are transferred out at 0, 15, or 20%, depending on your total income. The C Corp can make investments. It can buy you a car. It can pay rent. It can do all that other stuff. Pays a flat rate tax return, and in this case, 790,000. So the flat rate of 21%, 790,000 would be the C Corp's income, but it's locked in that C Corp unless you're distributing. If you are distributing and you're distributing this level of income, you would be at the 20% rate. So that would essentially be a 41% tax burden after the 21% flat tax. So it is not as advantageous to the S Corp if you're taking all the money out. But if you're just reinvesting that money, there's some advantageous stuff. So let me tell you a story.
How are we doing today? Good.
Good. Yeah, it sounds like someone maybe got off of mute. So let me dive through a story about a client that came to us. So this client was filing her own taxes on TurboTax. So in 2021, like a lot of real estate agents, she made a ton of money. She made almost $600,000. She found by, sort of thinking, oh, what did I spend on my desk fees, my expenses? She found about 150,000 of deductions. So when she ran it through TurboTax, she had about 450 in income and owed almost $200,000. The challenge is in 2022, she didn't do quite as good as she did in 2021. She only made $250,000. She had the same level of deductions, and so her net income was $100,000. And then on top of that, she probably owed another, $60,000 of taxes because she was, going to be subject to self-employment tax and a whole bunch of other stuff. The other caveat was she found her dream house, technically a dream rental, but dream house that she wanted to buy. And she needed about $100,000 for that down payment that she had from 2021. But in this case, on her TurboTax calculation, she was going to have to pay that to taxes. So with our bookkeeping and tax help, we went back through, took all of her business bank accounts, all of her personal bank accounts, and identified everything that was deductible for her from those bank statements and from receipts. And so we are able to increase her level of deductions through everything that's ordinary and necessary for her business, to increase the deductions by almost double, another $100,000. So that dropped her net income down to $350 for stuff that she'd already spent that year, that she'd already done. And so her tax burden dropped to $140. But that still wasn't enough to pull that $100,000 out to be able to buy this dream property. And so she said, oh, geez, this is still way too much tax. And with the penalties, she was really worried she was going to lose her dream house. And so what we did is we tried to understand how she ran her business and what was important about her business. And what came out that in 2021, she started a new part of her business that would come in and help do trash outs of the property. If you needed a new fence, if your fence was broken, she would do a little bit of construction on the fence. She would also help do a new roof and get essentially a payment out of the HUD for that roof replacement as a part of that thing. She also provided the staging through a whole, like about I think it was 4 containers. She had couches and beds and a whole bunch of other dining room tables and other staging assets that she used in these properties that she contributed to the business in 2021. And so what we did is we looked through and we found that she, between her construction equipment that she contributed to the business that year and these staging assets that she was using in the business last year, we had her create a schedule of all the assets, which added up to about $250,000. She'd never taken depreciation on these assets during the time that she was using them for the business. So we used bonus depreciation and catch-up depreciation to take a depreciation loss of an additional $250,000 off of that $350,000 of net income, creating a taxable income of $100,000 and taxes of around $37,000 for the year of 2021. Her borrowing ability continued to be that $350,000 that we see up at the top, allowing her to qualify for that $1 million loan with the $100,000 down payment that she was now saving on the taxes. A little bit more than $100,000, so she also had closing costs. So that's just an example of some of the stuff that we're doing. We really want to understand the business of the business owners and the realtors and how they're really running their business and help them optimize for their goals that they're doing. So I just want to throw out there a quick talk about the Fair Labor Standards Act. This passed on March 11th, and it changed how 1099 contractors are being treated. And so to be a 1099 contractor, there has to be an opportunity for profit or loss depending on your managerial skill, investments by the worker, not the employer, permanency of a work relationship, meaning it's not a permanent work relationship, nature and degree of control, whether the work performed is integral to the employer's business, and skill and initiative. The challenge with a real estate brokerage is realtors really want to be able to take the deductions that they validly have earned for running their own business. There's a couple of these 6 that really violate the Fair Labor Standards Act for a real estate brokerage. One being the requirement that you're hanging your business license at a single brokerage. That single brokerage creates a permanency in the relationship. And in some cases, if you take an extreme view of the Fair Labor Standards Act, it would require that the brokers paid these contractors that are getting their commissions as a 1099 contract or as a W-2 employee, effectively removing your ability to take deductions. Also, the work of a realtor is absolutely necessary for the brokerage, overall brokerage itself. And so there's a couple of these things, and you can make an argument for and against for every realtor. Just know what we've helped brokerages do and what we've helped individual realtors do is make sure that they're compliant and they're getting their own W-2 wages through the S-Corp, saving a ton on taxes. And then they're able to show, hey, we're running our own business, paying ourselves our own W-2 salary. You don't need to obligate us to be a W-2 employee under the Fair Labor Standards Act because that doesn't apply to us. We've also got professional exemptions. Some realtors have advanced knowledge in the field of real estate, and also the primary duty of selling real estate could also qualify for an outside sales exemption. So if you're working with Zccounting and especially John L. Scott, we've worked super hard to find ways to invalidate the Fair Labor Standards Act of requiring realtors to be paid as W-2 employees and losing all their deductions. So again, have a conversation with us and we'll help you work into that S-Corp. So let me give you a few takeaways. So one, you should be looking at your books and you should be tracking all of your ins and outs like a real business, because then you can make decisions and you can budget. We've seen too many times where a realtor has a really great month, spends all that money and buys stuff during that month, and then they don't have another deal closed for 2 or 3 months, and they're sitting on a load of credit card debt. So then the next time they're just trying to play catch up, their next deposit is just going to pay off debt, and they're not able to invest in more marketing or grow their business. And so one of the things that we highly, ring bells for realtors is look at your profit and loss. Look at how your business is doing. Track your expenses. Look at your accounts receivable cycle. How often are you closing deals? What is the lead time? Are you closing a couple deals a month? Is it every 3 months that you're closing a deal because the deals are larger and take a longer close period? And then also look at your payments. What are your accounts payable? What are your monthly bills that are fixed every month? What are the bills that increase or decrease depending on how much business? The other thing that we see across the board, realtors, small startup companies, software, marketing firms, everybody, SaaS subscriptions, your Netflix, your Microsoft, your Adobe, all of these subscriptions are just ballooning every month. And so if you're not tracking this, you could wake up one day and be spending $2,000 or $3,000 a month on $9.99 a month subscriptions, your Spotify subscription, all these subscriptions. And, a lot of these are business deductible subscriptions, but you really want to keep an eye on those SaaS subscriptions. I talked about it when we had our conversation on the balance sheet versus the profit and loss statement. Prioritize assets over loans. Assets give you depreciation and lower your tax burden. Loans increase your expense and lower your borrowing ability. So prioritize assets over liabilities. Think also about your fixed costs. The next one, gross margin profitability versus overhead expenses. Think about what are your daily costs that you have. What costs do you have when you wake up in the morning on the first day of the month that you have to spend versus costs that increase or decrease with your volume of business. So really understanding what are those fixed costs versus those variable costs allow you to make decisions and allow you to better run your business. The other thing that we're seeing that sometimes it's unclear what is really deductible. The rule to the IRS says it has to be an ordinary and necessary expense for the particular type of business, and it has to be non-excessive. And so one of the questions is, what does it mean to be non-excessive? Can I buy a Lamborghini Urus to drive to and from my open houses, right? Lamborghini Urus is what, about $600,000, right? It's a beautiful car. So if you're selling real estate in rural Idaho, it's ordinary and necessary for you to have a car, but our team would say, hey, a $600,000 Lamborghini Urus when you're selling $200,000 houses may feel a little bit excessive to the IRS and may increase your risk of audit. If you're selling the $10 and $20 million waterfront homes in Beverly Hills, or I guess $50 million Beverly Hills waterfront homes, and you're driving a Lamborghini Urus, it's probably reasonable and a reasonable expense. And so understanding those and having a team like ours to help you figure out what is ordinary and necessary, what is reasonable. We had a wealth manager that played in a band, and one of his clients was also in his band, and he spent $6,000 on a guitar for Guitar Center. That was not ordinary and necessary for a wealth manager. And so we had him take that as a owner draw or owner deduction, then did not let him take the deduction on there. I know that real estate agents, and I think that my hair is really important as well for these presentations, haircuts are also not deductible. We find that all the time. We help you move that to a safe place. The other great thing is if you are ever audited and the IRS agent says, how can we know that we can trust all these deductions? You can pull the account where the bookkeeper said, hey, we're going to take your haircut as a personal expense, not a valid deduction. And the IRS agent will be ecstatic that someone's watching over your shoulder and making sure that all your deductions are valid, approved, and substantiated. The other thing is work with your tax team, work with a tax professional to make sure you're the right company type, that you have the right structures of various LLCs, corporations, and S-Corps to optimize all the potential tax savings that you can have. So in summary, now everyone now is an expert in the basics of financial statements. Everyone on this call should know which business entity type that they should be. Hint, it's probably the S corporation because it allows you to pass through the most income at the lowest tax burden. I gave you a story from the trenches about a realtor who used our services, used the tax code to her advantage, and was able to buy her dream house. And I gave you some tips and tricks to take home, not just with protecting your ability to take your personal deductions through making sure that you're a valid 1099 contractor through your real estate brokerage, but also giving you tips and tricks on how to look at your books and how to understand your business on a monthly basis. So that concludes the presentation part of this presentation. And I think we have another at least 15 minutes to do some specific questions. If people want to just jump on the call and ask them or put them in the chat, I'd love to answer anything more specific for people.